Nigel Farage just lit up the crypto debate in Britain. According to The Telegraph, he accused dinosaur bureaucrats at the Bank of England of choking off British innovation and holding back the country's digital asset industry, arguing the UK is falling behind rival hubs. What is he reacting to? The backdrop is a tough policy mix. According to the Financial Times, the Bank of England has floated limits on how much of a systemic stablecoin people and businesses can hold, pitching caps of roughly £10,000 to £20,000 for individuals and around $10 million for firms as a way to protect deposits and financial stability. Farage's line is that rules like these, plus a culture of caution at Threadneedle Street, are throttling the sector before it can scale. Farage has been building a pro-crypto platform for months. According to The Telegraph's earlier reporting, he has even pledged the UK should hold Bitcoin on the national balance sheet and stop banks from debanking lawful crypto users, framing it as a competitiveness issue as much as a freedom issue. Today's broadside fits that message. He wants the central bank and regulators to move from risk first to opportunity first without ditching basic safeguards. Policy is shifting, but unevenly. According to the Financial Times, the FCA has sped up crypto approvals this year after criticism that applications were stuck for too long, and approval rates have climbed with more resources and clearer pre-filing guidance. Reuters adds that the regulator is consulting on a new regime that could give crypto firms a more tailored rulebook while still demanding strong operational resilience, custody, surveillance sharing, and consumer protections. In other words, Westminster is nudging the plumbing forward, even as the central bank keeps a tight grip on payments-grade stablecoins. Here is why the fight matters to markets. If the Bank of England's caps and caution dominate, the UK risks seeing tokenized money and on-chain payments scale elsewhere first, with liquidity and jobs following. If the FCA's faster approvals and a clearer ETF and exchange listing framework win the day, London could attract issuers, market makers, and builders who want rule of law plus speed. That tension is exactly what Farage is exploiting politically. He is telling voters that a more open stance can coexist with stability if the rules focus on transparency, custody, market surveillance, and accountability rather than blanket limits. There are fair counterpoints. The bank's core mandate is stability, not hype. According to the FT's coverage of the stablecoin debate, officials worrying that poorly designed coins used widely for payments could drain bank deposits in a shock, complicate lender funding, and amplify stress. In that world, transitional caps, rigorous audits, and phased rollouts look like a safety valve rather than anti-innovation dogma. The real question is whether those transitional measures stay temporary and whether the UK can build a pathway from pilots to production that global firms actually use. What to watch next? Reuters notes the FCA consultation window runs into November, so expect a flood of industry feedback on where to set the bar for integrity rules, custody, and market surveillance. Also watch how the Treasury positions itself between a speed up at the FCA and caution at the bank. If ministers lean into digital finance growth, you could see a compromise that tightens operational risk standards while easing firm-level approvals and clarifying payments use cases for well-regulated stablecoins. Bottom line. According to The Telegraph, Farage is swinging hard at the Bank of England to frame crypto as a growth and competitiveness story rather than a niche asset class. The next few months of FCA and BoE rulemaking will show whether London aims to be a top-tier crypto and tokenization hub or keeps its foot on the brake while others race ahead. You have been watching Cryptozard News. Please subscribe and like, and leave a comment if you enjoyed this video, and let me know what other crypto-related news you would like to hear in the future.